Hello everyone, welcome to today's stream. So I am going to go through some exciting data today and also give you my thoughts and insights on aspects related to off-plan property investing and the Liverpool property market itself. So I'm going to go through some advantages and then we're going to look at a case study for a residential development, a purchase example in Liverpool, which will show you the earning potential during that construction period and post-completion as well, just to really lay out and give you an idea of what to expect if you're considering off-plan investing. Now, for those that don't know, my name is Nick. I'm the Managing Director of Verta Property Group. We've got a network of over 31,000 investors globally. I've been doing this about 11, 12 years now. And we've got hundreds of five-star reviews, and we work with developers across the UK, help investors find properties, guide them through the process from start to finish for completely free of charge, ultimately until they have income coming into their account. So yeah, very well versed in the market. And Liverpool has been a big one for us over the years. It's been our biggest selling residential investment market for a number of reasons. But today, as I say, I want to focus on a off-plan example. So let's get into it. I'm going to share my screen now. Hopefully you can see that. Now, I've just listed out 9 points here, which I think are really important and should be considered when looking at your options of investing in the buy-to-let market. There's a lot out there, as we know. You've got new build properties, off-plan, social housing, purpose-built student accommodation, houses of multiple occupancy, rent-to-rent, rent-to-SA, property bonds. So there's a lot of different things you can do. But I think for our typical investor, which is someone that's normally in a well-paying job or operates a business, or sometimes they've come into a lot of capital, they typically don't want a local buy-to-let down the road that they're looking after and speaking to the tenant to every couple of weeks. So they want a good premium city centre property, which is going to generate a stable income for them, cash flow each month, and then obviously appreciate over time. So buying in these key markets like your Manchester, Liverpool, Birmingham, Leeds are often going to enable you to do that because they typically see the best demand. They've got more attractive entry prices compared to the likes of London, and the appreciation rates are very strong. So off-plan investing is purchasing a property during the construction period, most commonly from a developer, and you're paying less. You're getting various benefits because you're taking a little bit of extra risk, i.e. you're buying 12 months, 18 months before the project is finished. You're building in an uplift for yourself, and you're going to have a prime asset on completion. So the specific advantages, let's take a look then. So number one, you're leveraging growth on your deposit. So what I mean by that is these developers, normally they're going to ask you for 10 to 30% of the property value as a deposit to be paid on exchange of contracts, which can be any time in the purchase process, depending on when you're buying. But most commonly, as I say, 9 months, 12 months, 18 months, sometimes 2 years from completion, you'll put in your deposit. And then what you're doing with that, you're putting in obviously a portion of the value purchase price, but you're benefiting from the overall value rise during the construction period. So for example, if you put in a 30% deposit on a 100 grand property, you're putting in £30,000, but you're making your capital appreciation rate on the full £100,000 value. So if the property goes up, let's say it goes up 30% as well, right? So you've put in £30,000 as a deposit on a £100,000 property. The value has risen by 30%, just for an illustrative figure. That means you've made 30% profit, i.e. £30,000. So you've put in 30,000 and you've made 30 grand, which is 100% return on cash invested figure. So keep that in mind. You're making that value rise profit on the full asset value, not the deposit level. So yeah, it's a really good way to put in money and get it working for you. Number two, you can lock in today's price. So as we know, values typically across the UK at the moment, they're doing about 10 to 4.5% a year right now as we speak. I'm not talking about the last 12 months, but if you look at the market reports, that's what it's doing. So what you're doing now is purchasing the property, securing the price at today's value, rather than waiting 18 months to this build and having the market uplift during that period and having to pay a premium there. So locking in today's price is another one to consider. Completely passive growth. So there's no management aspect. You don't have to worry about mortgages. You don't have to worry about tenants coming or going or the Renters Reform Act yet. So yeah, it is very passive and an opportunity to earn income without having to do much. First choice of the best units. Now, this is what I really stress to people. When there's a lot of supply in a particular market, getting a unit with some form of unique aspect is very important. Now, that can be not just the physical appearance of the unit, i.e. the layout, the size, the view, where it's positioned on the floor. These are all important things, but also the price per square foot that you're buying in at, because ultimately that will dictate the rental yield that you're going to achieve. And if you want to exit at any stage, having a higher or showing a higher rental yield is going to be very profitable, or at least if you've got more margin to charge slightly better rate than someone else because you bought in at such a low price, can be really advantageous. But getting that first choice of units is really, really advantageous as an investor, because you're getting that unique aspect. You can get top floors, best views, best price per square foot, best layouts, best price, etc., etc. That's really important. So when people say to me, oh, you know, I just want to get something that's ready, some of this stuff you can't get because you'll be buying from someone that wants to sell. If they've got a strong unit, typically they're not going to sell it unless there's extreme personal circumstances. So yeah, you know, why don't I just wait until completion and buy then? It's because it won't be available on the open market. So keep that in mind as well. Optimize yield and price per square foot. I've kind of touched on this, but if you're going in at the lowest possible ticket price, the lowest possible price per square foot price, it means your end rental yield on completion is likely to be higher than someone that's bought 12 months later. So keep that in mind as well. Direct to developer pricing. Again, you're buying at base pricing from the developer. You're not paying another user who's looking to sell for maximum value. Okay, because if you're going into an off-plan development, these developers sometimes have got 100, 150, 200 units to shift. They're going to do it at a better rate than someone that's purchased, waited 2 years, and now wants to sell for maximum market value. So keep that in mind as well. Launch incentives. So we can squeeze developers for stamp duty contributions, legal fees contributions. We do free company setup and accounting, reduced management rates, free furniture packs, fixed returns from the developer or management company. All these bits and bobs you can squeeze out of the deal and ensure you're not only getting the best base price, but getting these little extra incentives as well. 10-year new build warranty and new build quality. Again, you're getting a nice, shiny new apartment with your new build warranty, 2 years worth of snagging. So any issues, that's taken care of. You should have a good block manager in place, a nice, really good standard product, which is going to attract the best tenants in the marketplace and should lead the rental values in the area, in the building. So yeah, that's another good one. And then just lastly, resale flexibility before completion. If your contract is structured correctly, you should have what's called an assignability clause, which means once you exchange contracts, which is around 1 month after reservation, you can then sell that property at any time to another buyer prior to practical completion. So it gives you a lot of flexibility. If you need to exit the market for whatever reason, if you get a good ride and the values pump, you know, relative in the real estate space, then you can exit and get out for a profit, which we have a lot of people doing. You know, flipping properties is very, very common, but you've got to make sure it's structured correctly in your lease. Cool. So hopefully that's a quick rundown of some off-plan advantages. And what I'll do now is go over to a illustration. And I want to just give you an example of what you can achieve from purchasing in Liverpool, which is what we're going to focus on, off-plan. Okay. So this is a breakdown of from exchange to exit, a full illustration of what a £250,000 purchase would enable you to achieve. Now, just before I go into this, the current growth rate in Liverpool, according to the Office for National Statistics, for the 12 months to January 26, which was the latest available data, was a rise of average values in Liverpool of 6.5%. Okay, so if you look on here, you can see house pricing Liverpool, Office for National Statistics. It's a great resource because you can type in the location now and they give you the rates. And you can see up to Jan 26, the year prior produced a 6.5% average growth rate. Okay, and that was over double of comparable cities and towns nearby in the same region. So even if you're buying in the Northwest, the same region, you can almost get twice as much better performance if you're buying in the right market. But that shows you there the 6.5% figure, right? So what I've done in this illustration is we've taken that 6.5% figure, and because in the purchase process of an off-plan property, you're buying in early, you're taking more risk, the value naturally increases as the construction proceeds, right? So in other words, you buy, you know, an off-plan investment with the shovel hasn't even gone into a ground yet. Obviously, that's a different value to a year later if they've put in the foundations and they've got going, etc., etc. So there's an actual value uplift that takes place during that construction period as well. So what I've done is I've taken a blended figure and I've said, let's just assume it rises 7.5% per annum, which by the way is conservative. 15% over 2 years for the UK's best performing residential market is not overstretching it, especially if you're buying in the town centre where the demand's the highest. Okay, so now let's look at that in terms of your deposit level and your purchase price. So I've said you buy a property for 250 grand. Let's assume you put in a 30% deposit. Okay, that's 75 grand. Now we look at a growth rate of 7.5% per annum, which is a blended rate of the ONS data and the natural construction uplift. And we look at a build time frame of 18 months. Okay, a year and a half, which is pretty typical in the off-plan space. So that would be the equivalent to an 11.25% return over that 18-month period. So by the time you get to completion, if you go by that data, the value is just shy of 280 grand. Okay, so 278,125. Now that, in terms of return on cash invested on your deposit, is a 37.5% return. Okay, over an 18-month period, because you've made just over 28 grand in equity. Okay, so you put in 75 grand and you've made just under 30 grand from doing nothing, just from sitting on the asset and letting that value rise. Okay, so that's pre-construction or pre-completion. Now let's have a look post-completion. Let's assume that that rate continues over 5 years, so that's 6.5% per annum rate. And let's also assume that you achieve an 8% net yield. Now, on the short-term let market, Airbnb, Booking.com, that's where you're going to be getting this type of value. Look, I'm not going to lie to you. It's very rare you get that 8% net for a new build quality asset slap bang in the middle of Liverpool these days. Okay, it's more likely going to be a 5.5% net return after your service charges, after your management fee. But we've assumed we're doing a short-term let model, which if you get short-term let approval on the development, if it's written in the lease, then you can certainly do that and you can certainly achieve that. So 8% is pretty much conservative. A lot of these developments, 9, 10, 11% is what they're advertised as. So we've just assumed an 8% flat rate on your original purchase price. Okay. Now, if you come down to this next graphic, you'll see that the value rises on average by, well, it's a annual growth rate of 41.5%. Looking at, sorry, not annual, that's over the 5-year period. So 5 years post completion, we assume it grows by 41.5%, which is that 6.5% extrapolated out. And here is the value rises. So starting off at 278, 296 at the end of year 1, then 315, etc., etc., etc. So you get to the end of the 5-year period, you're looking at an equity growth rate in terms of cash value of £102,930 if that original 6.5% plays out. And remember, Liverpool has just achieved 6.5% over the past year in the good performing areas, even though it was a soft market. Okay, there's a lot happening, a lot of instability, and the sentiment has just been really negative in the UK. So seeing that over the next 5 years, I think is entirely achievable. And then we've said at that 8% rate, which is £22,250 per year in rental income as a net return. Okay, that's just assuming a cash purchase in this case. So you move that over a 5-year period, that's a total of £111,250 just in the rental income. Okay, so just to summarize that post completion stage, the value of the property now, because it's appreciated in construction at 7.5% per year, is worth just under 680 grand. Now we're saying we go back to that 6.5% figure over a 5-year time frame. That's just over 380 grand of asset value. Okay, so capital gain 102 grand over that 5-year period. Now let's assume an 8% net rental yield, which per annum would be £22,250, translated to a monthly return of 1,854. And then if you look at that totaled over a 5-year period, that's £111,250. So now if you add the equity gain and the rental income together, you're looking at £214,180 in profit. Okay, so as a percentage on your deposit, that's 323%.1. Okay, so just say 323%. Now that's because you've obviously put in that deposit there. So yeah, really, really attractive figures there, and those are entirely achievable. Okay, so whether you achieve that 323%, obviously it depends on you you leveraging, and if you're leveraging, your cash flow on the rental income is going to be lower because obviously you have to take into account mortgage repayments. But let's just assume that you were just doing a cash purchase and forget the 323%, but you're still looking at 214, 180 in profit made from the equity and from the rental income. So yeah, really, really attractive indeed. And that just shows you the off-plan power of investing. And again, you're only achieving these figures because you're buying in at that lower ticket price and that lower price per square foot rate, which is allowing you to achieve that one, aggressive appreciation, and two, that 8% rental yield. Because if you buy a premium asset that's ready now, that's brand new, you're not going to achieve that 8% yield because you're going in at that higher price. Okay. So this only only achievable if you're getting in at that base pricing with those incentives added on top, et cetera, et cetera. So yeah, hopefully that gives you a bit of a summary, guys. I wanted to explain that because let me just remove this, because obviously a lot of our investors, they come to us and they say, look, I just want to generate cash as quickly as possible. So, you know, a lot of them will come and say, look, I want M1, I want the centre of Manchester, I want Liverpool, I want a 9% return, and I want it ready right now. And you have to say to them, that's like gold dust. Everyone in the market is looking for that, okay? So you just have to be realistic. And I'm not saying plow all your money into off-plan investing. We have complete and operational buy-to-let properties as well. I'm just saying you need to be aware of the return on cash invested potential return, the overall benefits, the negotiation position that you're in, the net yield post-completion. And obviously on the downside, you have to manage your risk, ensure it's a reputable developer, ensure it's worth waiting to get that asset in that location, et cetera, et cetera. But hopefully that gives you a bit of a run through, guys. Any questions, just let me know. Again, I'm trying not to be overly optimistic on that market data. So we're looking at a, you know, pretty substantial purchase price for Liverpool, 250 grand. And we're looking at a 8% net rental yield. And I've got developments in Liverpool now, which do 9, 10, 11%. Okay, so 8% is somewhat conservative in my opinion. And then the construction uplift, we've only assumed it will be a 1% difference on that 6.5%. So yeah, hopefully giving you a realistic overview and not selling you a dream, but really helping you understand what the benefits of investing in off-plan are, and particularly in Liverpool. So yeah, any questions, guys, let me know. Hopefully we'll speak soon. And that's Nick at Verta Property Group. Cheers.